Chasing massive overnight gains with automated trading usually ends in exactly one way: total and complete account liquidation. Forex Fury takes a different path, utilizing an algorithm designed to intentionally cap its own upside. The math is straightforward. The software costs $459 upfront, and historically it generates a modest 2 to 3% return each month. This raises an obvious question. Why would a trader spend nearly $500 on software that yields such slow, boring returns? To find the answer, you have to look past the top-line percentage and match the software against your specific capital structure. The actual value of this tool depends entirely on the amount of capital you have available to trade. The algorithm operates within a highly constrained window, activating only for a single hour between 10:16 and 11:16 during the London Open. It targets this specific hour to take advantage of the market's peak daily liquidity and the resulting price volatility. Once a trade is opened, the exit parameters are perfectly equal. The bot targets 16 pips of profit and risks exactly 16 pips of loss. Because of this one-to-one risk-to-reward ratio, the system relies on a high accuracy rate to maintain profitability over time. These strict boundaries completely eliminate the possibility of the massive, high-risk trades that often lead to outsized losses. As a result, the algorithm usually only finds one acceptable setup per day, requiring a high degree of patience from the user. This regimented 1-hour, 16-pip structure trades the excitement of constant market action for a strictly defined mechanical process. The true test of a trading bot occurs when a position goes negative. Many automated systems use grid or martingale strategies, which double down on losing positions to force a quick recovery. Forex Fury's code rejects these methods, refusing to utilize any grid or martingale recovery mechanics. This graph shows the result. While the chaotic red line represents deep drawdowns of high-risk bots, the steady blue line shows Forex Fury's drawdown, capped at a remarkably low 3%. The trade-off is speed. You cannot force a recovery. You wait for the system to naturally grind back. Despite slow recovery periods, the overall trajectory of the blue line shows a steady climb. By refusing to double down on bad trades, the algorithm removes the risk of a sudden account blowout, making capital preservation its primary function. The real question is how that $459 software cost fits into your specific financial plan. Consider a budget-conscious beginner trading a $500 personal account on the left side of this matrix. At a 3% monthly return, that $500 account yields a profit of only $15 per month. At that rate, it would take more than 2.5 years just to recover the initial $459 cost of the bot. Now look at the right side of the matrix, the prop firm trader who uses a small fee to access $10,000 or more in funded capital. Prop firm traders usually fail because they hit the strict 10% maximum drawdown limit enforced by the funding company. Forex Fury's historical 3% maximum drawdown aligns perfectly with these strict rules, serving as a buffer against account termination. A 20% total gain on a $10,000 funded account generates $2,000 in gross profit. With a standard 80% profit split, the trader keeps $1,600, paying off the software cost immediately while securing a significant return. The high cost and slow growth make this bot a poor choice for small personal accounts, but those same safety parameters provide a specific advantage for those managing high capital funded accounts.